They didn't ring a bell, they didn't hold a press conference, they didn't warn the public, but overnight, the rules changed. And when the rules change quietly, it's never for the small investor. It's always for those who are about to win. Today, we are talking about silver, power, and a system that moves fastest when it feels threatened. The CME didn't just adjust margins, they slammed the brakes. And when institutions panic, it's usually because something much bigger is coming. The change came without warning, without consultation, and without any meaningful attempt to prepare the market for what was about to happen. In a single move, the CME sharply raised margin requirements on silver, instantly increasing the capital traders needed to hold their positions. For many participants, this wasn't a routine adjustment. It was a sudden shock. When rules change overnight in a market as closely watched as silver, it immediately raises a critical question. Why now? Markets thrive on transparency and predictability, and when those pillars are quietly pulled away, the timing itself becomes the story. Margin requirements are not just technical numbers buried in exchange rule books. They directly determine who can stay in the market and who is forced out by raising margins. The CME effectively increased the financial burden on traders at the exact moment when silver was attracting renewed attention and growing participation. Positions that were manageable one day became expensive the next, pushing the smaller and highly leveraged players into difficult decisions. Some were forced to reduce exposure, others to exit entirely. The result was instant pressure, not because fundamentals changed, but because the cost of participation did. What made this move stand out was its precision. Silver was not in chaos, liquidity had not collapsed, and there was no emergency announcement pointing to systemic risk. Yet the adjustment arrived swiftly, suggesting urgency rather than routine maintenance. History shows that exchanges rarely act this decisively unless momentum begins to challenge existing market structures. When price action accelerates and sentiment shifts too quickly, control mechanisms are often deployed under the banner of risk management. That label sounds neutral, but its impact is anything but. For market participants paying close attention, this was not just a margin hike, it was a signal. It signaled that silver had reached a level of attention that demanded intervention. It suggested that the trajectory of the market was moving faster than some were comfortable with. And it reinforced a pattern that is repeated across financial history. When participation broadens and confidence grows. Among smaller players, the rules tend to tighten. The playing field doesn't change evenly. It changes in ways that favor those with deeper capital and longer time horizons. This moment forces a reassessment of how modern markets operate. Exchanges present themselves as neutral facilitators, yet their actions can dramatically reshape outcomes in seconds. The silent nature of this change is what gives it weight. There was no dramatic announcement, no public debate, just a recalibration, reshuffled risk across the board. For those watching closely, the message was unmistakable. When momentum builds quietly, the response is often louder than words. When institutions move suddenly, it is rarely accidental, and it is almost never emotional. The sharp increase in silver margins sent a clear signal that something deeper was unfolding beneath the surface of the market. Institutional players do not react to headlines or rumors. They react to risk exposure and loss of control. When margin requirements are raised aggressively, it often reflects concern that price movement is accelerating beyond comfortable boundaries. That concern is not about daily volatility, it is about trajectory. And trajectories are what institutions monitor most closely. History shows that markets are left alone when they are behaving as expected. Slow, manageable moves do not trigger emergency tools. What triggers them is momentum that builds faster than models predict, and participation that spreads beyond traditional players. When confidence begins to rise outside institutional circles, risk shifts in ways that cannot be easily hedged. That is when protective measures appear. The margin hike in silver fits this pattern precisely. It was not a response to panic selling or collapsing liquidity, but to growing strength that was becoming increasingly difficult to contain. Here's the hook most people miss. Fear at the institutional level does not look like chaos. It looks like control. It looks like rule adjustments, recalibrations, and technical language that sounds harmless on the surface. But behind those adjustments is a recognition that the market is moving in a direction that threatens existing positioning. When too many participants align on the same bullish outcome, especially in a market as historically sensitive as silver, the imbalance becomes a risk of its own. The speed of the margin change also matters. Gradual adjustments suggest routine maintenance. Sudden hikes suggest urgency. Urgency suggests exposure. Institutions manage risk by staying ahead of momentum, not chasing it. When they are forced to act quickly, It implies that momentum has already reached a level that demands immediate attention. This is not weakness in the market, it is strength being acknowledged in an indirect way. There's also a psychological layer to these decisions. Higher margins introduce friction, they slow participation, reduce leverage, and force hesitation. And that hesitation is intentional. It buys time. And in markets, time is the most valuable asset institutions have. By increasing the cost of staying involved, confidence is tested, not fundamentals. Those with deep pockets barely notice the change, while smaller participants feel the pressure instantly. That imbalance is not accidental, it is structural. The most revealing aspect of this move is what it implies rather than what it states. Institutions do not fear silver itself, they fear disorderly repricing. They fear rapid shifts that expose mismatches in supply, demand, and paper positioning. When defensive tools are deployed this early, it tells a story that official statements never will. The message is subtle, but unmistakable. Something is building, and it is being taken seriously. The idea of silver reaching levels once considered unthinkable has moved from the fringe into mainstream market conversation. When a price target like $85 silver starts circulating more openly, it reflects more than speculation. It reflects a shift in collective expectations. Markets are driven as much by belief as by balance sheets, and when belief changes, behavior follows. What makes this moment significant is not the number itself, but the speed at which that number has entered serious discussion among analysts, traders, and long-term investors. Price narratives do not emerge in isolation. They form when multiple forces begin to align: tightening supply, persistent industrial demand, inflationary pressure, and growing distrust in paper-based assets. Silver sits at the crossroads of all these forces. It is both a monetary metal and an industrial necessity, making it uniquely sensitive to global economic transitions. As these pressures intensify, higher price projections no longer sound radical, they start to sound logical. That is, when attention shifts from whether such levels are possible to how disruptive they might be if they occur too quickly. Here's the hook that changes the perspective. Markets fear speed more than they fear price. A slow climb can be managed, hedged, and absorbed, and a rapid repricing cannot. When aggressive price targets gain traction, institutions are forced to consider worst-case scenarios, not best-case ones. An $85 silver discussion implies structural strain on short positions, on physical supply chains, and on the credibility of pricing mechanisms that rely heavily on derivatives. That strain is what captures attention behind closed doors. The growing visibility of this narrative also changes participant behavior. As more people begin to anticipate higher prices, accumulation accelerates. Long-term holders become less willing to sell, reducing available supply, speculative interest increases, amplifying momentum. This feedback loop is powerful, and once it begins, it is difficult to reverse without intervention. Markets rarely correct narratives with words. They correct them with mechanisms. Margin adjustments, liquidity controls, and rule changes often follow when expectations threaten to outrun infrastructure. What makes the $85 silver conversation especially sensitive is its symbolic weight. It represents more than a profit target. It represents a challenge to long-standing assumptions about value and scarcity. For years, silver has been perceived as undervalued, yet restrained, promising, yet contained. When a concrete number breaks through that psychological ceiling, it reframes the entire market. Suddenly, the question is no longer why silver should rise, but why it hasn't already. The shift in narrative forces institutions to act preemptively. They do not wait for confirmation. They react to probability. When enough credible voices begin treating a higher price regime as realistic, the risk of inaction grows, and the conversation itself becomes a catalyst. And in markets, once conversation turns into conviction, momentum is no longer optional. It becomes inevitable. The immediate impact of higher margin requirements is rarely felt by large institutions, but it is felt instantly by retail traders. This is where the pressure becomes real. When margins rise sharply, the cost of staying in a position increases overnight, regardless of whether the market thesis has changed. For smaller participants operating with limited capital, this creates a forced decision point, not because they are wrong, but because they are suddenly required to pay more simply to remain involved. That distinction matters, and it exposes how unevenly market mechanics can operate. Here's the hook most people underestimate. Markets don't always remove players by being right or wrong. They remove them by making participation unaffordable. Margin hikes do exactly that. They turn time into an enemy. Retail traders are pushed into a corner where holding conviction becomes expensive, stressful, and risky. Even strong positions can become liabilities when the rules of engagement change without notice. This is not a test of analysis, it is a test of endurance. As margins rise, leverage shrinks, positions that once allowed flexibility now demand constant monitoring and additional capital. For many retail traders, this pressure leads to forced liquidation at unfavorable prices, not because the market invalidated their outlook, but because the financial strain became unsustainable. This creates a cascading effect. Selling driven by margin pressure adds volatility, which then justifies further restrictions. The cycle feeds itself, and the original narrative of risk management becomes self-fulfilling. Meanwhile, institutional players operate under a completely different set of realities. Higher margins are an inconvenience, not a barrier, with deeper capital reserves and longer time horizons. They can absorb the cost, wait out volatility, and even benefit from the exits of smaller participants. As retail traders step aside, liquidity consolidates, and influence becomes more concentrated. The market doesn't become safer, it becomes quieter, and quiet markets are easier to control. This is where the structural imbalance becomes impossible to ignore. Retail participation brings diversity of opinion, momentum, and volume. When that participation is squeezed out through technical adjustments, price discovery becomes distorted, moves appear calmer on the surface, but the underlying tension grows. The absence of retail traders doesn't remove demand, it delays it. It pushes interest into the background, waiting for a moment when conditions feel fair again. The most revealing aspect of this pressure is its timing. It arrives precisely when confidence is building, when participation is expanding, and when narratives begin to challenge established expectations. That is not coincidence, it is a filtering mechanism. Only those with sufficient capital, patience, and emotional control remain. And while this process is often framed as necessary discipline, its real function is far more strategic. It reshapes who gets to stay in the game when momentum matters most. Intervention in financial markets is often misunderstood because it is rarely dramatic. It doesn't arrive with sirens or headlines. It arrives through technical adjustments that sound procedural and routine. Yet history shows a consistent pattern. The most aggressive interventions tend to appear not during collapse, but during moments of growing strength. This is the paradox that many overlook. When a market is weak, it is often ignored. When it begins to show resilience and acceleration, it starts attracting attention from those tasked with maintaining stability or control. Here's the hook that reframes the narrative. Markets are not restrained because they are failing. They are restrained because they are succeeding too quickly. Weak markets burn themselves out. Strong markets threaten assumptions. When fundamentals begin to align and sentiment shifts in the same direction, price discovery can become disorderly. That is, when intervention becomes tempting, not to stop the market entirely, but to slow it down, reshape participation, and regain timing advantage. Historically, these moments appear near inflection points. Whether in commodities, currencies, or equities, sharp rule changes often precede significant moves rather than follow them. Margin hikes, trading halts, and liquidity adjustments tend to cluster around periods when momentum is building and confidence is spreading. This does not guarantee immediate continuation, but it does signal that the underlying trend is being taken seriously. Authorities do not intervene in irrelevance. They intervene when outcomes begin to matter. What makes these interventions so revealing is that they target behavior, not fundamentals. Supply and demand remain unchanged. Industrial usage does not disappear. Monetary conditions do not suddenly reverse. What changes is the cost and ease of participation. By altering those variables, the pace of the market can be influenced without openly challenging the underlying thesis. It is a subtle approach, but an effective one. It allows control without confrontation. There's also a psychological dimension that cannot be ignored. Interventions introduce doubt at precisely the wrong time for momentum. They force participants to question their confidence, reassess timelines, and reconsider exposure. This hesitation can temporarily interrupt trends, but it rarely eliminates them. In fact, hesitation often concentrates conviction among those who remain. The crowd thins, but the core strengthens. Another overlooked signal is repetition. When similar interventions appear repeatedly in the same market over time, it suggests a recurring tension between fundamentals and structure. Markets that are truly weak do not require constant oversight. Markets that keep pushing against boundaries do. Each intervention becomes a data point, not an anomaly. It marks a zone where pressure is building and where the system feels the need to respond. The mistake many make is assuming intervention equals failure. In reality, intervention often confirms relevance. It confirms that the market has reached a scale, speed, or importance that can no longer be ignored. When controls tighten as momentum rises, it tells a deeper story, one where strength is acknowledged indirectly and where the next phase is being carefully managed rather than dismissed. Volatility is often portrayed as danger, but in reality, it is information in motion. When markets become unstable, they reveal where pressure is building and where conviction is weak. The key distinction is not whether volatility exists, but who knows how to interpret it. Disciplined participants understand that sudden swings are not random. They are the visible result of hidden adjustments, taking place beneath the surface. This is where opportunity begins, not ends. Here's the hook that separates professionals from spectators. Volatility doesn't punish ignorance, it punishes impatience. Emotional reactions turn temporary price movement into permanent loss. Those who act without a plan become liquidity for those who have one. In moments of sharp uncertainty, the market quietly transfers value from reactive hands to deliberate ones. This transfer is not fast, but it is relentless. When rules change and pressure rises, many participants respond by chasing clarity that doesn't yet exist. They demand immediate confirmation, instant stability, and guaranteed direction. Markets do not provide those things on demand. They reward those willing to sit inside uncertainty without forcing outcomes. Discipline in this environment is not passive, it is active restraint. It means understanding, position sizing, managing risk exposure, and resisting the urge to act simply to relieve discomfort. Volatility also has a cleansing effect. It exposes weak assumptions, excessive leverage, and overconfidence. Participants who relied on borrowed time and borrowed capital are forced out, leaving behind a market that is more structurally sound. This process can feel chaotic, but it is constructive. It resets expectations and rebuilds momentum on firmer ground for those prepared. This reset creates entry points that do not exist in calm conditions. There is also a timing advantage embedded in volatility. Sharp moves compress decision-making for the unprepared while expanding it for the patient. When prices move quickly, emotional traders focus on survival. While disciplined participants focus on alignment, they assess whether the original thesis remains intact, whether fundamentals have shifted, and whether the volatility itself has created mispricing. Often, the answer is yes. The most valuable skill in volatile markets is perspective. Short-term noise can obscure long-term direction, but it does not erase it. Those who anchor their decisions to fundamentals rather than headlines gain clarity as others lose. They recognize that volatility is a phase, not a verdict, and within that phase, prices often move further and faster than logic alone would suggest. Opportunity rarely announces itself calmly. It arrives wrapped in uncertainty, doubt, and discomfort. Volatility amplifies all three. For the disciplined, that amplification sharpens focus rather than blurs it. It reveals where fear is excessive and where conviction is justified. In markets shaped by sudden rule changes and shifting expectations, discipline is not just a defensive strategy, it is the defining edge. So don't ask yourself, why are they doing this? Ask yourself, what are they afraid of? Because history rewards those who stay awake while others panic. History rewards those who think long-term while others react short-term. And history always exposes the truth after the shakeout. The rules changed, the test is on, and the real question is not where silver goes next. It's who has the courage to stay in the game when it matters most,